In our Asia ex-Japan model portfolio, we are currently overweight India. It may appear surprising in the context of a continuing economic slowdown in India, but we would point out that stock selection is relatively easier in India. There's a pretty wide universe of companies which generate excess return routinely, that is, return on equity is higher than the cost of equity. And they're also strewn across a wide range of sectors like consumer discretionaries, consumer staples, private sector banks, even the IT companies which have been staging a recovery of late. Or in other words, the foreign investors have a much wider canvas to choose from, which is reaffirmed in the trend that we see in terms of foreign flows. Whenever it recovers in emerging markets, India is one of the key beneficiaries. This rally that we've seen in the market, obviously that's been a liquidity-driven rally, which is understood because earnings growth estimates for fiscal 20 kept on drifting down all across the year. And as a consequence, valuations for India have actually moved up as the market rallied. That said, I must also point out that there is a wide divergence in valuations across different classes of stocks. So if one looks at the top tier stocks, the high quality stocks, they are clearly expensive at this point of time, but the foreign institutional investors are still attracted to them, not just because of their high quality, but also their relative stability in their earnings estimates and the liquidity that they offer. If one goes down the top tier stocks to the mid cap and small cap stocks, there's a degree of divergence even within those classes. So the relatively high quality mid cap stocks are way more expensive than the second and third tier. So we think that while the market may appear expensive when one looks at the headline valuations, it does offer stock picking opportunities, and it would be possible to outperform the broader market with careful stock selection. Here again, as I said just now, I would hesitate to paint a broad brush picture saying that it would be a year of mid-caps. Because within the mid-cap universe or even within the small-cap universe, there's a divergence in terms of quality and there's a divergence in terms of valuation. So one would have to be selective in terms of stocks. So I think it really would be a stock picker's market. There are a few macroeconomic factors that need to fall in place. Currently, earnings growth in India is being predominantly led by financials, particularly the private sector banks and insurance, and a few companies, particularly in the consumer staples and some of the consumer proxy areas. So we need to see a bit of a divergence, a bit of a broad basing of that universe before we see a sustained earnings estimate recovery. So one would have to see some degree of recovery in the industrial space, which I think would only happen once we begin to see a sustainable recovery in capacity utilization, which would in turn be triggered by a demand recovery. Now obviously these are difficult to achieve in the near term. And I don't think there's any magic bullet that's available either for the government or for the central bank. I would think that one would have to wait for maybe the second half of fiscal 21 to see some of these variables fall in place. It pretty much ties in with what I said just now. If I look back at the key economic components, private consumption, investments and government consumption, I think the first, attempt on the part of policymakers should be to improve private consumption, or in other words, consumption demand. And that in turn can lead to private investments improving at a later date. it would obviously need some degree of fiscal support, which unfortunately, the government does not have at this point of time. So, a more sustainable economic recovery beyond what we're likely to see from pure base effect would take, possibly longer, maybe another 2 to 3 quarters at least. So we come back to that, same old equation, but it's basically the second half of fiscal 21, when we can expect to see some degree of stabilization. The sectors in India which have possibly spawned the most compounders are consumer staples, consumer discretionaries, private sector banks, IT services. This is where, these are the 4 sectors where you find most of them. Our ways to identify them are simply to look at excess return generation, or in other words, the companies that generate a return on equity higher than cost of equity on a sustained basis over 15 to 20 years or so. Majority of these companies, majority of these excess return generators fall into these sectors that I mentioned just now. Indian companies historically have been very careful, one could even use the word stingy, about raising capital and investing, because India was a capital-starved economy historically. And that is why Indian companies routinely generate higher ROE and ROCE than the rest of the emerging market. And I think this is the characteristic that has stood the Indian market in good stead, and it has also engendered FII interest on a sustained basis. I think the wish list would be, as I said, that I'm not really looking at an absolute number, when it comes to fiscal deficit. I would rather be concerned about what goes inside, the fiscal deficit or fiscal spending. So I would look carefully at whether the measures are designed to support or, invigorate private consumption. I would try to look at some of the structural ways of resource raising, structural and sustainable ways. So if one gets a credible impression of the government trying to raise resources from either divestments or asset sales, that would clearly be a positive. One would also look for credible assumptions as far as tax revenue growth or broader GDP growth goes. In a nutshell, it is not just the headline numbers that we would look at. We would try to see what are the assumptions that have given rise to those headline numbers. In the conversations that we have had with our clients, foreign investors, most of the questions that we face are actually centered around the economy, around corporate earnings, to be more specific. And what are the implications of the measures that the government or the central bank that can take on these? To answer your questions in a nutshell, I think foreign investors at this point of time are more concerned about these the specific numbers concerning the broader macroeconomy and corporate earnings, than about other variables that that the domestic Indian investor base or the market watchers may be concerned about.